Hi, my name is John McCallick. I'm an accounting educator at University College Dublin, and I've been teaching financial statement analysis for 30 years now. This video is about analyzing services revenue. It's part of a series of videos that started off with an introduction to analyzing revenue recognition. I really recommend that you go back and look at this video if you're not familiar with revenue recognition technology like performance obligations, discrete products and services, and things like that. So please do go back and look at that video. I'll put a link in here so that you can go back. This video is going to look specifically at services revenue. There was another one on physical goods, which also included some discussion of services, because often physical goods are provided in conjunction with some kind of services. Okay, so let's get on with this video. Firstly, a disclaimer. You can read this for yourself. None of this presentation is intended as investment advice. This video is intended to help you understand how revenue recognition works and how to analyze how it works in particular situations. So let's just look at services, something like providing a hotel room and providing breakfast. One thing we've got to decide on, which goes back to the original introductory video, is whether these services are discrete and whether we should be recognizing them in different ways, recognizing the revenue from them in different ways. So a performance obligation like this, if you can only buy the hotel room and the breakfast as a package, then they're not discrete. They're highly interrelated, and we should recognize the revenue from them together. If, however, breakfast is a separate contract with the customer, then it might be regarded as discrete. Okay, so this is something that we've got to decide on for our revenue recognition policy. So let's look at an example. An airline, which provides obviously transportation services, has contracts with customers that include a flight and loyalty points. So what do we do about this? Are they one performance obligation? No, they're not. They are separately identifiable and distinct. So we've got to deal with them in different ways. And we will recognize the revenue from the flight at a point in time when the flight has been provided. Now, of course, the customer will have paid us for this flight in advance, generally. So that will mean that we will have significant amounts of contract liabilities on the liability side of the balance sheet. These contract liabilities represent the obligation the airline has to provide the flight to the customer when the customer actually takes the flight. Now, the loyalty benefits, we are going to recognize the revenue at a point in time, but a different point in time when the loyalty benefit has been provided to the customer. So you get points on a flight now. In 6 months' time, you have enough points together to cash them in for another flight. It's at that point, in 6 months' time, that the loyalty points, the revenue from the royalty points, will be recognized as revenue. Now, of course, the tricky bit here is going to be dividing up the ticket price between the flights and the loyalty benefits. Some airlines obviously sell points, sell loyalty benefits, and if they have a standalone selling price for those points or benefits, then that's great, and that's the way you should do it. Otherwise, maybe you have to estimate what the value of the loyalty benefits are. You might need to use some analytics there to work out what benefits customers actually get from loyalty points, and maybe be even more sophisticated and look at what types of customers get benefits and what are their value. Okay, so let's look at IAG, the International Airlines Group, the parent of BA, Aer Lingus, and Iberia, a number of other airlines. And here we see that their policy is that revenue allocated to Avios points, that's their loyalty program, has been determined based on the relative standalone selling price of each performance obligation. So they are looking at standalone prices, which is good. That's verifiable. And they say down here that revenue allocated to the Avios points is deferred and recognized when the points are redeemed. So that's my point from the last slide, that you've got to wait until the customer actually gets the benefit from the points to recognize the revenue. Now, the upshot of this is that you're going to have a lot of contract liabilities on the balance sheet of an airline. And we're switching over here to the Lufthansa group, the German airline. And let's just remind ourselves what a contract liability is. An entity's obligation to transfer goods and services to a customer for which the entity has already received consideration, or the amount is due from the customer. It's in receivables as well, could be the case. And Lufthansa have a number of contract liabilities here. They have long-term contract liabilities, which is quite a small balance. And then they have billions of euros in contract liabilities for flights that have been paid for but not yet provided. So that is, they call it here contract liabilities from unused flight documentation. And then there's other contract liabilities that are mainly from their loyalty programs. And this makes up a big portion of their balance sheet. So this is how the accounting should work in somewhere like an airline, where you're receiving revenue in advance. You then have an obligation to provide services to the customer in the future, and that has to show up on your balance sheet as a contract liability. You can see in this case it's divided into two bits. One is the contract liability to provide the flight in the future, and the second bit is the contract liability to provide benefits for loyalty points in the future. Okay, so let's move on then and look at a different type of situation. A software company provides access to its software using a 3-year contract. The fee is paid monthly and includes support services and upgrades. So what are the software company's performance obligations? Well, the contract is to provide the software, and generally, if we're doing this on a monthly basis, we recognize revenue over time, where each month's access, when each month's access has been provided, then we can recognize the revenue. Now, for support and services upgrades, this can differ depending on the particular circumstances of the software developer. We can recognize revenue at a point in time when the support or upgrade has been provided, or maybe in a situation where we're kind of continuously providing support and support services and upgrades. We could also maybe recognize that over time. So that could maybe go either way depending on the particular circumstances of the software developer. So let's look at a real example of a company like this. This is a company called Sage. They're an accounting software provider based in the UK. And here is their revenue by segment. And they show us a geographic breakdown here. But more interestingly, underneath, they're showing us their software subscription revenue here and other recurring revenue. And this makes up 2.2 billion British pounds of their revenue. So they are recognizing that the revenue is recurring, and we're now going to dig a little bit deeper into what that means. So they define recurring revenue as revenue earned from customers for the provision of a good or service over a contractual term, with the customer being unable to continue to benefit from the full functionality of the good or service without ongoing payment. So this is not like a software license where you buy some piece of software and you can continue to use that forever. In this case, the recurring revenue says that the customer needs to continue to pay for the full functionality of the software. And they have another category here. Subscription revenue is recurring revenue. So it's what we described above, earned from customers for the provision of a goods or service. In the event that the customer stops paying, they lose the legal right to use the software, and the company has the ability to restrict the use of the product or service. So you can't just go on using it. You need to keep making payments. And other recurring revenue primarily comprises maintenance and support revenue provided over a contractual term. In the event the customer stops paying, they lose access to technical product support, as well as any non-specified updates, upgrades, and enhancements. So this software company, most of their product provisions are in the cloud. So they are charging the clients on a monthly basis, and if the client stops paying, then they lose access to the services. So how do they do the revenue recognition then? Well, subscription revenue and other recurring revenue are usually recognized on a straight line basis over the term of the contract, as control is transferred to the customer. So usually it's on a straight line basis. If there's a term license in there, like a 5-year license or something like that, then the revenue is also recognized over that term. So the timing of recognition: licenses for standard on-premises software products are typically delivered by providing the customer with access to download the software. The license period starts when the access is granted, and the customer therefore has control of the software. So in that case, in an on-premises type of installation, they will recognize the revenue from the software when it's provided to the customer. Where the group's performance is the grant of a right to continuously access a cloud offering for a certain term, revenue is recognized ratably over the term of the contract. So if you have a 5-year contract to provide cloud services, you are recognizing the revenue over each month of that contract, and you're probably being paid on a monthly basis as well. So it's probably all lining up. Maintenance and support revenue is typically recognized based on time elapsed and thus ratably over the term of the support agreement. So they're saying that they're doing this over time. Essentially, they're not, allocating revenue to specific events. When they're doing upgrades or providing a support assistance, they're doing it over time. Okay. So I guess that gives us a good sense of the kind of decisions they've made about their revenue recognition, which all seem very reasonable in the light of their business. And there's another little issue here, which I think I should mention you should look out for when you're analyzing software companies and, any kind of provider of services that may involve a reseller. So identification of contract with the customer, when the group sells goods or service through a business partner, so there's some kind of middle person or reseller. Key consideration is determining whether the business partner or the end user is Sage's customer. And you've got to see who has taken control of the product. And the issue here is if the business partner, is just reselling Sage's products and, doesn't really have a meaningful inventory of them, then we really should only recognize the revenue when the end user takes control of the product, when the reseller actually resells to the end user. And we should not be taking revenue when we, provide licenses or something to the reseller and they just keep them until they find an end user who's going to use them. So that is a concern with software companies like this, and you've got to keep an eye out on it, eye out for it, that they're not recognizing revenue from resellers too soon before the reseller has actually found an end user for that software. That's not the case here, but it's just something to look out for. So, how is revenue turning into cash for Sage PLC? Most contracts seem to have ongoing payments and revenue is recognized evenly over the contract term. So there's probably little difference between cash and revenue recognition from customers. And you can see this down below in the relatively stable relationship between deferred income this year and last year. You can see here they're about 750 million, and that is not a huge level, and also it's stable over time. So that's the kind of thing I'd be looking out for in a company like this. Are there significant management judgments here? Even though it's a service industry and you usually associate that with, revenue recognition, subjective judgments. Here, they're getting in payments each month. They are recognizing the revenue each month. There doesn't seem to be a huge amount to worry about here. Possibly, I'm not saying this is the case with Sage, but in other software companies, you might start to worry that they have non-paying customers that they're continuing to provide products for in the hope that they will at some point in the future be able to pay for those services, and they're recognizing revenue from those contracts. You would see that if receivables were going up very quickly, but that's not the case. That's not the case here. You could also see it, I think, by looking at receivables as a percentage of revenue. So the kind of questions you've got to ask about revenue recognition for services: what services are being provided? Are there different performance obligations? Are they discrete or interrelated? How are they recognized in revenue? So what's the timing of them being recognized in revenue? And when are they turning into cash? The services we looked at here were fairly straightforward. The next video is about the contracts, longer term contracts, and where longer term contracts involve services. I'll deal with that in that video. So look at the revenue breakdown, contract assets, contract liabilities and receivables, and obviously look at the accounting policies that the company has to see that they all seem reasonable in the light of the kind of services that they are providing. Thank you very much for watching the video. Please like and subscribe to the channel. I'll be providing more of this kind of content on different aspects of analyzing financial statements. Bye.